Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Mr. Jonathan Twomley. How are you, sir?
Good, thank you. I don't think I'm quite the only Jonathan Twombly out there,
Yeah,
but there aren't that many of us. So
you're the best one.
I'm the best one. Yeah,
There you go.
absolutely.
There you go. Well, hey, I thought what we should do, something I'm doing with all my experts this week, because they all come with different kind of bias, right? I have some single family, some multifamily, some Airbnb guys, some builders, some agents, because everybody feels a little different after the Federal Reserve's Jackson Hole meeting. I know you've been busy on other activities. You've been on a vacation. So let me kind of summarize what Jerome Powell said in about 8 minutes, and then let you react and ask questions and kind of see what it means for your world. Are you okay with that?
Absolutely.
So my take on Jerome Powell is he came out and basically had three themes. Theme one is rates are going up. They're going up higher than people expect, and they're going up faster than people expect. Two, we have learned from the past, and we will not do the fits and starts of the 1970s. We are going to keep them up much longer than you expect. There is no Fed pivot on our horizon. Subsequent, just so we know, since we're talking about this, Fed presidents have come out and said no cuts in 2023, as an example, where some people were talking about Cathie Wood September cuts. So again, this is all new information. And then lastly, they basically came out and said, we've got to help the masses, right? And I did on my daily financial news, 10% of Americans own something like 71% of all assets. The other 90% are hurting. Inflation is a nasty tax on the people that least can afford it. That's our combined focus. Get inflation to 2%. Damn the torpedoes. We don't care of a recession. Yes, it's going to be painful. In fact, he used the word painful. There's pain ahead. Unemployment is going to go up. Job losses are going to go up. The economy is going to slow down. Jerome Powell has since dropped soft landing from his vernacular. He's like, hey, we got to get a recession. So my inkling from all of this, rates higher, rates longer, rates faster, and 2023 is going to suck from an economy perspective. What are your thoughts?
Well, that's a lot to unpack. So yep. I'll do my best. Rates higher. So I guess the question you have for me is, how is this going to impact multifamily, or is this general question?
I think this one is general. We'll do more multifamily in the second episode, because I have a specific thought. But just in general, the market said, hey, we're the 1%, the 10%, time for you to show some pain. We're going to help everybody else.
Yeah, listen, I mean, I think that, Powell kind of sticking it to Wall Street is kind of interesting, because Wall Street clearly, even though, this is not, what he said is not a surprise, right? He's been saying this the whole time, but Wall Street wasn't listening. They were saying, oh no, we believe that the Fed's just going to come back and lower rates, and it's all going to be happy for, we're going to go and continue along the same path.
The Fed put is real.
The Fed put is real. They only care about us. They don't give a crap about the little guy, and it'll all be fine. And Powell has never, all of his statements over the last, several months since inflation got to be an issue that the Fed felt it had to deal with, have been pretty consistent. So it's interesting that he came out and said, like, no, guys,
you're not listening. Yeah.
You're not listening. I really mean it. We mean it. We're getting inflation under control, and you guys, we're taking the punch bowl away. Right. So, listen, I agree. If interest rates go up by a lot, then there's going to be pain. I think, again, I've said this before, I think the Fed is making a bet that the pain is not going to be too great, because the economy has been strong, and they think that the economy can absorb this. But look, the Fed has been basically creating like a massive transfer of wealth from everyone to the upper echelons of society for a generation now.
Yeah, or a generation or two. Yeah.
Yeah. But really since really around after the dot-com bust.
Correct. After 2000. Yep.
So it's been 20 years now that the Fed has basically thought that the only people who matter are Wall Street.
Correct.
And they have essentially, if you look in like places like California and New York, where you and I live, the Fed is responsible for the unaffordability of those places. And people complain about taxes and stuff, but it's really, when people are moving, it's because of the cost of housing. And the
Correct.
cost of housing has been a function of keeping interest rates too low for too long,
Correct.
such that it has moved the prices of real estate out of reach of most people, right?
Agreed.
In those places. And it wasn't always that way, and it was not that way 20 years ago.
Mm-mm.
And the difference between 20 years, there's been some gentrification, yes. There's been some foreign money coming in, yes. But you want to talk about the real issue is it's that the Fed created a huge, massive asset price, whether you want to call it bubble or just massive asset price appreciation.
Mm-hmm.
And it has basically benefited investors at the expense of everybody else.
Yeah,
And
the only people that won the last 20 years were asset owners, which are the top 10%.
Yeah, asset owners are people who could get their hands on assets, right? And they were the ones who, and low interest rates essentially incentivized people to, to get into investing
Mm-hmm.
and take assets out of the hands of people, of homeowners and what have you, right? So
Mm-hmm.
the Fed has really been, in my view, very responsible for creating the inequality that we have today through basically, listening to Wall Street and just continuing to, give them crack, right? So
yeah, no, I agree. They've served the few at the cost of the many.
Yeah, and so I think now they're realizing a bit too late that they really went too far in the direction of easy money.
Mm-hmm.
And now they've got to dial it back, and they've got to dial it back pretty hard, because the chickens have finally come home to roost, after this COVID thing. So, I think, as I've said before, they kind of tentatively tried to do this in 2018, and Wall Street screamed at them.
Mm-hmm.
And then all they did was create like another even bigger bubble in real estate. And I think they've gotten scared. Now that, they thought they could get away with it. They thought that as long as they kept inflation low, it was okay, but they've destroyed the ability of people to save. They've destroyed the ability of people to get into like the biggest wealth creator there is, which is owning their own home.
Mm-hmm.
If you look around, and what I see everywhere is like the financialization of everything. Like people are figuring out, investors have so much money on their hands. They've got more money than there is to spend on traditional assets. So they're looking into like, well, what else can we buy and financialize? So like they're trying to buy people's degrees, right?
Yeah.
See if they can like essentially convert people into slaves, right? For their forever by financializing their college education and selling it off to investors. Like pretty much everything you can think of right now, there's somebody out there trying to figure out how Wall Street can take it over. And this has been the result of low interest rates. So I'm glad to see Powell sticking it to Wall Street. And even though it's going to cause some pain for you and me, look, when interest rates were much higher, guess what? People made money in real estate.
Yeah.
When interest rates were 20%, guess what? People made money in real estate. Like
exactly.
It's the issue is not that you can't make money in real estate at high interest rates. The issue is that if you bought at really low interest rates and you expected them to go on forever, then there's going to be some pain, right?
Oh yeah. Yeah. There's a lot of people, and neither you or I, right? We've got, you and I have documented track records that when stuff gets overpriced or we think it's overpriced, we'll sell. Yeah. And we don't go into situations where we get bad debt and 1-year bridge loans and all this other stupidity that you and I have been ranting against, and wrong, right? People have been betting on red and winning.
Yeah.
It's going to be a problem there. I really do believe there's going to be a vintage of multifamily syndication, much like 2005, 2006, 2 and 28 teaser loans, where 90% of them went bad. I think there's going to be a 18-month window, maybe 12-month window of syndications, all bridge debt, all bad assumptions, refi at the wrong time, because I think rates are going up. There's going to be pain to feel. If you were gambling on appreciation or lower rates or collapsing cap rates, you're going to lose. That's what Powell said. This is going up. I'm sorry, bad bet. Take the L.
Yeah, so this is, I mean, the pain is going to be involved here, right? In some way. And and when Powell says that pain is going to be involved, I mean, I didn't see his comments directly, so I didn't know whether he's talking about like, hey, Wall Street, there's going to be pain, and hey, you investors, there's going to be pain.
I think what he was referring to, at least in the speech, was unemployment. He was basically saying there's going to be economic pain and unemployment's going to go up. Now, you and I know that fact ripples through to stocks and all of that, but I do believe he was saying, hey, folks, I'm sorry, unemployment's going to go up from 3.5 to 5.5. Right. It's going to be millions of people. That's what he was saying.
You know, but again, 5.5 used to be what they considered natural unemployment.
Right? No, I mean, I have a degree. When I was studying economics and also for the first 10 years post that, full employment was 6%. That's crazy. Yeah.
6% unemployment, right? That was what was
full employment. Like,
they literally believed you couldn't
go below it. Yeah.
Well, you couldn't. Well, listen, you couldn't. But this is what's interesting, right? It wasn't that you couldn't go below it. It was that if you went below it, you would cause inflation.
Right.
So, and what happened was we managed to go below it for quite a while without causing inflation. And that let the Fed continue to keep interest rates low, right? Because it didn't create inflation, but there were a whole lot of factors going on, like outsourcing jobs to China. The jobs were, lower quality, goods were cheaper, right? So there was all these things. What wage inflation didn't result from extremely low unemployment,
correct,
because the jobs weren't that good, right? And the stuff being produced in China was like extremely cheap. But now you've got all these different things going on, like resourcing to the reshoring to the US, disruption of supply chains, like maybe the undoing of some things that never should have happened in the first place. Again, the whole kind of like, free trade mantra was like, oh, it's, competitive advantage. China can produce it cheaply, so that's better, right? Well, yeah, better for the people who make the stuff, but not, I mean, for who own the factories that make the stuff. Not so much better for the people who used to make the stuff here and then lost their jobs and got lower quality jobs instead, right? I mean, a lot of like the political dissension that you see in the country is a direct result of the loss of those good working class jobs because of Wall Street, right? So now I think and like the whole Trump phenomenon was directly related to that, right? That like someone was finally talking about, hey, this is stupid. So a lot of people responded to that message, right? And we're going to bring the jobs back, right? Someone finally said it and changed the political debate, right? So I think we're seeing a lot of these things happening now, and it's going to cause, maybe the long-term result is going to be good, but it's going to cause some short-term dislocation.
I think I'll reiterate that. I think a decade from now, this is all good, but in order to get from here to the decade, there's going to be pain felt.
And listen, like you and I have said many times before, like recessions are painful, but they're necessary.
Correct.
And we've been trying to avoid, we've been trying to avoid business cycle recessions for a generation, and all we did was create financial crises in their place, right? And so now I think, if we can get back to normalized higher interest rates like we used to have, encourage people to save, let them have saving, let them have a way to save and earn money that's not risky, right? So you can invest it, you can put money in a bank account and actually earn interest and keep up with inflation. You can put money into a treasury bill and actually earn interest and keep up with inflation. Like these are good things that the economy needs.
Agreed.
The economy doesn't need everybody investing in like the riskiest stuff out there because they can't get a yield. They can't get yield anywhere else, right? So
it's not good.
So I think, I mean, maybe I'm projecting too much of my own like wishes onto, just like Wall Street was. Wall Street was projecting its wishes onto Powell that he was going to lower interest rates. Maybe I'm projecting my wishes onto Powell that he's going to like hold the line.
We're going to find out September 21st. I'm going to take him at his word. I love the fact that he was succinct and short, 8 minutes. He's got to bang us with 75 on September 21st. If he does anything less than that, Wall Street won, in my opinion.
Yeah.
So Jonathan, do me a favor. Where can people find you? We got a hot topic for number 2.
Oh man, you're not letting me rant anymore.
No.
All right. So if you want to find me, all right. If you would like to get on my investor list, please go to twobridgesassetmanagement.com. you can Google it. That's the easiest way to find it. Two Bridges Asset Management LLC, and fill out my investor form there. We do have active deals, and happy to get on the phone with you and chat. That's one way. If you would like to join my Facebook group, it's called the Multifamily Investment Community. We're about to undergo with some big changes. There's still secret under wraps, but we're gonna have some big things coming out in the next few months, and that'll all be announced. But get into the group now. You can see it all happen.
Awesome.
And yeah, so those are two good ways to get in touch.
Yeah, folks, you got to join the Facebook group. And again, if you want to see what conservative underwriting is and you're an accredited investor, fill out the form, get on it. I'm on it. I see the deals. I like how he does it. I compare it to others, and it's laughable, some of these assumptions that these other operators are doing. So Jonathan, thank you for all you do.
Thank you.